So let's just talk about taxes. One of the biggest expenses for people, especially in the United States, but really around the world, it's taxes. Because now when you go to work and you get paid, you got to pay your income tax. When you get paid from your job, you also got to pay your payroll tax. That's your Social Security, your Medicare. When you buy a house, you pay a property tax. You go to the grocery store, you got to pay a sales tax. You buy a stock and you sell it for profit, you pay a capital gains tax. If you die with a lot of wealth and you pass it on, you got to pay an estate tax. We now have to think about tariff taxes. If you are a corporation, you have to think about corporate taxes. Depending on where you live, like California, you have to think about state and local taxes. And then we have the other taxes, which could be your cigarette taxes, your alcohol taxes, your toll taxes. And it goes on and on and on, but I just kind of bucket them all into one because we could be talking about taxes forever. So there's a lot of taxes that you have to pay. And I'm telling you this as a licensed attorney, who's not your attorney, but there's a lot of different types of taxes. So now the question is, what can you do legally to pay less money in taxes? Keyword legally. Because Warren Buffett, we've been talking about him. He was one of the wealthiest people in the world, but paid a lower tax rate than his secretary.
How's that possible?
Because you are not taxed based off of how much money you make. You're taxed based off of two things. You're taxed based off of, number one, the category of money that you make. And number two, the taxable income that you have. Not your income, your taxable income.
So what's the difference between income and taxable income?
When I buy a rental property, and let's say that I made $10,000 of profit after all my expenses, there's $10,000 in my bank account. That's my income. It's $10,000. That's how much money I have in my pocket. But I'm not going to pay taxes on $10,000. I'm going to pay taxes on my taxable income. Because when I invest in real estate, I get to qualify for bigger tax write-offs that are legal. So one of these is called depreciation. Every year my property is 1 year older. Hopefully it's going up in value. But regardless of whether it goes up or down, I can tell the IRS, hey, because my property is a year older, I deserve a birthday gift. Depreciation, which is a tax write-off. I get to tell the IRS I made $10,000, but I'm only going to pay taxes on a fraction of that. Sometimes I'm going to pay taxes on $0, depending how smart and how sophisticated I can be, because I take the value of the property and I'm going to write off a piece of that value against my income. So depending on how aggressive that I am with my accountant, I could say I made $10,000, but I'm only going to pay you taxes on $1,000. So now my tax bill goes from way up here to way down here just because of the way that I filed my taxes. And so that's the difference between income and taxable income. You don't get to do that when you earn your money just from your job. But there are things that you can do if you work a job. And this is where now getting into the financial sophistication, it becomes incredibly powerful. And the reason why is because we've talked about now how if you can do slightly better with your investments, it can lead to significantly more wealth. Well, your taxes are one of your biggest expenses. What if you could just figure out how to lower your taxes by a little bit?
Yeah.
Now, all of a sudden, you got a lot more money to buy your food, but also invest your money. And now all of a sudden, you can throw a lot more money into your investment. So what do? The first thing is don't overpay the IRS, because the average American is overpaying the IRS. How do I know that? Because the average American gets excited when they get a tax refund. I hate to break it to you, but your tax refund is a 0% loan that you are giving to the United States government.
You could have had it within your investments earning money during that time.
All that tax refund is the government is giving you money that you overpaid to them. They said, you paid us too much money. We held on to it for a year, but here it is a year later. Wow. And because of inflation, we know that the prices of things are getting more expensive. Something that costs $100 today is going to cost $103 next year, $105 next year. So if I give the IRS $100 today, they're going to give it back to me in a year just the same way that I gave it to them. So they got to use it, but I don't. So how do you lower that? The IRS during the pandemic time created a tax withholding calculator. Go onto their site, see how much money you should be withholding. That way you're not overpaying the IRS. Simple fix, it'll take you 15 minutes. If you have an accountant, they can help you with that. But there's a simple thing that you can do. Number two, it's going to require more risk, more work. But you can start now identifying ways that you can use the tax code to your advantage. Now I'm going to come back to what I said just a minute ago to help answer this question. I said that you're taxed based off of the category of income and your taxable income. The IRS has identified 3 buckets of income, 3 categories: ordinary income, otherwise known as earned income, portfolio income, and passive income. Your ordinary income is the money you make from your job. This is your W-2 income. Your portfolio income is your stock market income, your investment profits. Your passive income is things like my real estate rental profits, or if I wrote a book and I was making royalties from a book, that's all passive income. These 3 buckets have different tax rates and different tax breaks. So when you go and make a lot of money from your job, your top tax rate is 37% at the federal level. If I go and make a lot of money from my investments, my top tax rate is 20%, which means I could make a lot of money and pay half in taxes just by making my money through the stock market or other investments as opposed to the job. Now you're going to say, Jaspreet, that's harder to make your money from investments. You're right. But does that mean you should never strive towards that? But now let's go back to your question. So now that you understand there's 3 different buckets, what should I think about as a W-2 earner, as an employee, to pay less money in taxes? Well, what if now you work a job, you are, I don't care what you do, you're an engineer, teacher, doctor, but you have a passion for gardening.
Mm-hmm.
So now you start a gardening podcast or blog or website. So you go and open up an LLC. Now, when you open up this LLC for gardening, now you are a business owner.
Yep.
And as a business owner, you get to qualify for special tax write-offs and deductions. So when I go and purchase the equipment for my company, I need a cell phone, I need a laptop for my company, maybe I need a microphone. These are now tax write-offs for my company. And if my company is losing money, I lost more money than I made because I had to invest in these things, I can take that loss from my company and use some of it or all of it to offset my job income. But it gets even more interesting when you start to see what is the power, what is the definition of ordinary and necessary? Because what the IRS says is that you can write off ordinary and necessary expenses for your business. And I'm telling you this again as an attorney who spent a lot of time studying the tax code. If I'm in the garden, I like gardening, and I see that there's a beautiful gardening conference happening in Hawaii, and me and my business partner, who is my wife, need to travel to this business event in Hawaii. We need airfare. I need a hotel.
Food.
Might need some food. Might need a rental car in Hawaii. Well, now this is not a vacation. This is a business trip with my business partner. And this now becomes a write-off for the business. Now, of course, you have to engage in business activities. You have to go to an event. You should be starting to make some money. But now you can start to see how you can use the tax code to your advantage, because now these things can become a way to offset your income as well. And that's just one form of, now we think about wealth preservation. The other part is now thinking about protection. No wealthy person actually owns any real estate. I just Singh, I'm a real estate investor. I own 0 real estate.
Really?
Well, I guess I own my house. Well, even that's not under my name. Nothing is under my name.
Huh.
I own real estate under trust or LLCs. Because if I own a property myself and I rent it out to somebody and they slip and fall, now that person can sue the owner of that property. And if I'm the owner of the property, that means I, Jaspreet Singh, am liable, which is why wealthy people don't want to own these assets. They own an LLC or an entity that owns the asset. So now when I open an LLC, let's just say I call it Jaspreet Singh LLC. Jaspreet Singh LLC owns the property. Now the tenant slips and falls in the property. They sue the owner of the property, which is Jaspreet Singh LLC. Well, the most that they can take is whatever that entity owns. Not my personal assets, not my personal things that I own, not my bank account, just that LLC. And if the LLC only owns that house, that is the most that they can take in the worst case scenario. That way you can protect your assets. And this is where now you start thinking about, okay, what are things I can do to protect my assets, to pass my assets on, to give back to the world? Because as you start to build wealth, you need to be thinking about that